Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of May 26th. Thank you for joining us. If you're a first timer, thanks for checking it out. And if you're a returning customer, thanks for coming back. Don't forget to like and subscribe below if you enjoy the video and find the content helpful. As always, my intention for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that, let's get ready to hit the books and get up to speed on the markets. So as usual, let's start by taking a look back at last week. Last week, there wasn't a whole lot of economic data, but a couple areas we're going to touch on. So first and foremost, we got our regular weekly unemployment insurance program update. As we've seen for the last few weeks, and in fact, the last couple months, we didn't see major changes among the initial claims or the continuing claims. Although initial claims dropped slightly and continuing claims increased a little, we're ultimately still waiting to see if the tariffs and potential disruptions to the economy could result in short-term layoffs. Early in the week, we also saw the leading economic indicators report out of the Conference Board. And not unexpectedly, we saw the leading economic index drop by a significant amount in the month of April. In fact, the decline from March to April was the largest we've seen since early 2023. We also saw the monthly Purchasing Managers Index, or PMI report, out of S&P Global last week. And a little bit of good news, we saw business activity and expectations for the future both rise slightly from their April lows. Unfortunately, we also saw export volume fall, and we saw disruptions to the supply chains magnify significantly from April to May. In addition to these changes, we also saw a huge surge in the price of goods and services sold, ultimately reaching the highest level we've seen since August of 2022. Additionally, exports of services fell by the largest amount that we have on record, excluding the changes related to COVID. Taking a quick look at the housing market, last week we saw existing home sales fell for the month of April, but new home sales increased over the same period. We also saw that the supply of existing homes increased by 21% over the last year and has now reached levels that we haven't seen since pre-COVID. The supply of new homes for sale has also increased, with about 8 to 9 months worth of supply currently sitting on the market. Turning our attention over to the earnings reports, Home Depot shared a mixed earnings report last week, ultimately beating on revenue, but missing on earnings, and sharing that they saw same-store sales drop by 0.3%. Lowe's actually beat on revenue and earnings, but ultimately their revenues dropped 2% over the last 12 months. Turning our attention to Target. Target was the other large retailer that reported earnings last week. Target missed on revenue, missed on earnings, and dramatically downgraded their forward guidance for 2025, citing concerns with consumer demand and concerns with additional costs that were related to tariffs. Switching over to the stock market, it was unfortunately a tough week for markets this week. The week started with a downgrade of the U.S. credit rating. Then we saw quite a bit of uncertainty and a little bit of drama surrounding the House of Representatives' approval of their version of the tax bill. And last of all, towards the end of the week, we saw President Trump announce potential tariffs of 25% on Apple, or at least on iPhones that may be produced outside the US, and a 50% tariff on goods and services across the board from the European Union. Given all this turmoil and increased uncertainty and a return to trade war threats, we saw all three major stock indices drop for the week. All three dropped approximately 3%, give or take a small amount. To put this in context, all three of the major stock indices are now back in negative territory for the year. We saw significant disruptions in both the stock market and the bond market throughout the week, and we saw a significant pullback in the value of the US dollar. Previously, this trade or this pattern of trades has been referred to as the Sell America trade, where we see equities, bonds, and the US dollar all sell off at approximately the same time. Turning our attention over to the bond market, rates on 10-year and 30-year treasuries both increased significantly following the ratings downgrade and throughout the majority of the week. We did see a slight surge in the bond market towards the end of the week. Ultimately, rates on the 30-year treasury broke the 5% threshold for the majority of the week, and yields on the 10-year treasury rose as high as 4.6% before ultimately falling back down to about 4.5% to end the week. Taking a quick look at some of our alternative markets, Bitcoin returned to its historic volatility, ultimately seeing prices rise as much as 8% at one point during the week, hitting a level as high as beyond 112,000 per coin, but towards the end of the week falling back down to a more reasonable level, ending the week closer to $109,000. We also saw crude oil take a pretty significant dive throughout the week, losing a healthy amount with a slight recovery on Friday afternoon. We saw the US dollar also lose value throughout the week with a couple big hits at key points, ultimately again emphasizing the Sell America trade on both Wednesday and Friday. In stark contrast, we saw the gold market, which is typically considered a safe haven, rise significantly throughout the week with big jumps on both Wednesday and Friday in response to turmoil in the equity markets and bond markets. Moving into this week, our earnings reports for this week are being headlined by tech giant and AI mega cap Nvidia, which happens to be the third largest company in the S&P 500 by weight, following Apple and Microsoft. Given the size and the role of Nvidia in equity markets and the S&P 500 specifically, once we see the announcements of Nvidia's earnings later in the week, we will most likely see markets moving significantly in response. In addition to Nvidia, we'll see about 15 other S&P 500 companies reporting earnings this week, including CRM software giant Salesforce and retail giants Costco, HP, AutoZone, Ulta Beauty, and Dell Computers. The reason that the retail giants are so important at this point is both continuous monitoring for consumer spending habits, as well as concern that these companies may express in their forward guidance given the impact of tariffs and potential economic slowdown. On the economic side of the house, we'll see two big economic reports this week. As far as hard data is concerned, we'll see the first revision to the first quarter GDP report. Again, just to refresh your memory, the first report for GDP was negative growth of 0.3%. Ultimately, any significant movement in the first revision to this result, up or down, could help to foster more optimism or help to stem more pessimism. We'll also see the inflation report, the personal consumption expenditures report that the Federal Reserve prefers in their monitoring of the inflation in the US. What we most likely expect to see is a slight increase in month-over-month inflation, although we may see a slight decrease in 12-month or annual inflation. Ultimately, everybody is still watching for the potential impact of tariffs as the flow of additional costs and potentially higher prices moves throughout supply chains. The big question is, when will it reach consumers? On the soft data side, this week we'll actually see our May consumer confidence report coming out of the Conference Board, and we'll see the final results of the May consumer sentiment report coming out of the University of Michigan. The preliminary results for the University of Michigan report showed that there was continued deterioration, but at a slowing pace for the month of May. So, of course, the big question in the soft data is, will we see another month of continued deterioration and growing pessimism, or will we see a slight pullback on the pessimism as a sense of optimism may have spread slightly through the month of May, given the tariff pause on the China tariffs and the ongoing trade negotiations with the rest of the world? Wrapping up this week as far as economic data, we'll actually see our monthly report on durable goods manufacturing, our monthly report on retail and wholesale inventories, and the trade balance for the month of April, meaning the balance of imports and exports during that month. Last of all, we'll see some important information on home price data across the United States coming from both the Case-Shiller Home Price Index and the National Home Price Index. Looking a little further into the future, one of the things that we'll be watching is specifically Walmart raising prices following their announcement that any price increases this month would be the direct result of tariff costs. Some of the questions this brings to mind are how many other companies will follow suit should Walmart raise their prices by also raising their prices and directing the blame at the tariff costs. In addition, the potential exists for companies that haven't experienced increased tariff costs to also increase their prices at the same time, given the cover that's being presented by Walmart and the potential plausibility of increased inflation more generally. What are we going to see if prices start to rise? Consumers are already price sensitive. They've already started to complain about the potential for increased inflation. Will we see consumers pull back on spending and reduce their consumption? Or will we see, as we saw a few years ago, will we see increased grumbling about higher prices, but continuing ongoing spending and consumption? As has been the case for the last 5 months, uncertainty has been the word of the year. As we move forwards, I want to encourage you to come back here and join us every week. Again, our purpose for making these videos is to go out and read the economic data, read the reports, and condense it into something that we find helpful and informative and easy to understand for you, the viewers. So with that in mind, as uncertainty persists, as the economy and the financial markets change on a daily basis, make sure to swing back here every week, check out the work we're doing, and allow us to help keep you up to speed on the markets. Thanks for joining us this week. Good luck, and we'll see you in next week's video.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.